Hi, welcome to Market in a Minute. 2025 is going to be a year of probably big change occurring. So, Trump's policies are completely different, 180 degrees different from Biden's. There's going to be a lot of things put in place that are going to be really positive longer term or on the intermediate term. And maybe the market may perceive some of these as being very negative on the short term. But we think the year's going to be very volatile, but we have a plan in place. We think we can make some money this year, maybe some nice money this year in this volatile period of the markets. So first of all, what I like to do before I walk through our plan and then how Trump's policies impact everything, I like to walk through 2024, what happened, and what the setup is. 2024, the economy in 2024, it's hard to figure out. The economists have not pulled out what the fiscal spending really added to the economic growth, but it was massive. So we had massive spending on top of previous years' massive spendings. So the economy, the pie of the economy, is so large in terms of what the federal government is currently, and it's going to shrink. So we've had restrictive, quote, restrictive monetary policy. But, we had an inverted yield curve for longer than any time in history, but the market didn't react to it. Of course, housing didn't do well and the basic materials were really hurt bad. But the restrictive policy with the Federal Reserve constantly saying we're going to cut rates and the market believing them and expecting 8 cuts and we only got 4, they had such a positive bent towards cutting rates that the stock market really didn't acknowledge what was going on with the yield curve. So we had certain areas, certain sectors of the economy do really poorly, but the stock market just went up very nicely the last 2 years because of how the Fed spun it. Now they have to slow down because inflation's not coming down and the 10-year Treasury bond went up. We think up in terms of yield now at 4.6%, which is not a good setup in terms of the valuation for the overall markets. But what happens in this environment is that the general economy doesn't grow because the massive federal spending is the driver, and growth beneath that is really actually kind of slow or zero. And the only thing that's growing is the federal budget and some growth stocks. So you can see here, this is the S&P 500, the red line here, up 23% last year. Very strong year. The average stock, or another way of looking at it, is the equal weighted S&P 500, up only 11%. So quite a difference. We find a lot of really interesting companies that are lower in market cap, so that they're not in the top 10 of the S&P 500. And if you look at this. This is the mega cap technology stocks, up 62% last year. What a year, right? And the average stock up 11. So big divergence in the overall markets. We think that the markets need to rotate in the worst way. So this has never happened before. We have the markets being very, very narrow, with 30% of the S&P 500 outperforming. That's happened before. But what hasn't happened is that the top 10 companies in the S&P 500, now because of these massive moves back to back, they account for nearly 39% of the overall market. So the overall market's never been this concentrated, which really concerns us that if anything happens to these top 10 companies, that you're going to see a very significant decline. So if you remember back in, say, 2000 as an example, remember Yahoo and Nokia and American Online. Well, 2 of those 3 companies don't exist anymore, and Nokia is a penny stock. So this can happen. So these mega cap stocks can come down in value. They're not going to go away, not like those companies, but they can come down significantly as their percent ownership of the overall weighting in the S&P 500. Now, if you combine the S&P 500, 23% return last year with a say a 50-50 or 60-40 allocation, you got something in the low to mid teens in terms of a return. That's not bad, but the bonds did really poorly. So the belly of the bond market, as they call it, that 3 to 7 years, did not perform well. The Barclays Aggregate Bond Index was up just roughly 1% last year. Baby bonds did really well. Baby bonds returned their coupon, which is roughly 7.5 to 8%. That was really nice. We like baby bonds a lot. That's the way to structure a portfolio. And the other thing that we owned last year was the short end of the yield curve. So the 30-day Treasury, the BIL, we own that as well. So our bonds actually performed really nicely last year. So we're concluding how 2024 shaped up is that the markets are highly valued. There are a handful or more, say 30, 100, 160 stocks that outperformed, say 30 that are really highly valued, 10 that are really, really highly valued in terms of their market caps. And so it puts the overall market in a risky profile. Beneath those companies, say in the bottom 250, there's some really attractive stocks. And in small cap stocks and mid cap stocks, there's some really attractive stocks. So the stocks themselves look so much better than the overall stock market. So we're hoping for a rotation. So we think that the Trump policies are the catalyst for change. Maybe the change is somewhat disruptive to the overall stock market, but that will be the catalyst to get the market to rotate. So the timing is what's at issue. So we're going to see spending come down in a big way next year, federal spending come down in a big way. It's going to be, the Biden current spending is going to be cut like you wouldn't believe. And then federal spending itself will actually be cut too. So prior to the COVID, we think that federal spending will come down the base level from there, but also all the Biden spending is going to get probably wiped out. If you look at the federal spending currently, so the last couple months, October, November, it's still running up 18% year over year. So we're thinking we might see a fiscal cliff next year. As we cut all this spending back, the economy is not going to like that. So the economists won't like the federal spending coming down in such a dramatic way without the rest of the pie growing. So we need this private sector of the economy really picking up the slack, and that timing issue is what's concerning with a highly valued market. But underneath that, there's some really interesting stocks. So let me show you that federal spending quickly. So here's COVID, right? Boom, COVID. And then we saw the Biden election plans. So his plan was to spend like crazy to get reelected. He spent like crazy and probably cost him the election because inflation didn't roll back down. Now, a couple of other ideas before I move on from this point is that we think that the Americas will be a really interesting place for investments from Canada all the way down to Argentina as Trump forces his policies upon the world, right? But also this area in general. We thought for years that Latin America was a big opportunity for the U.S. and we let China take it. I think that this administration is going to focus on Central and South America, Canada, and it's really intriguing what they're talking about with Greenland. That's not likely going to be reflagged, and neither is Canada. But there likely will be some sort of cooperation for the Americas, including Greenland, over time. Now, this is an important point. We don't think Iran, shortly thereafter Trump getting in office, is going to be able to sell an ounce of oil to the international markets. And if Russia doesn't cooperate and find a solution to the war, they will not either. So we see this as a big positive for U.S. energy providers. And this is one of the areas that the markets have really lagged a lot. We like this area plus some other areas, which I'll go into in a second. So again, very ugly chart. This chart, you could see this kind of come back to you might be able to get 2 trillion out of these cuts. I know the interest expense has gone up quite a bit, and that's part of it. But you might be able to get at least a trillion cut, if not 2 trillion, over time. Now, the 2025 outlook. Okay, so again, more volatility to come. A number of disruptive issues that Trump is going to put in place. So this is the Trump economy beginning. It's not going to be pretty probably when it first starts. There's going to be things put in place that people are not happy about, and the markets may discount a recession because of so much cut to federal spending prior to the private sector picking up. So valuations in general, valuations has been driven off of these 10 different stocks this year. So valuations may compress as we rotate. So some of that money that's, say, in Apple is growing 10% or less with a 35 multiple. Well, that's the same thing that's J&J is doing. They're growing roughly 10%, and they only have a 13, 14 multiple. So why can't money roll out of one of the largest companies in the world, if not the largest, into a really high quality company like J&J that has a good story? So we could see some rotation into these quality blue chip companies out of these really large cap technology companies. So remember, technology is, if you add back all the tech related companies that the S&P pushed off into different sectors, but if you add all those back to tech, like Google and Amazon, etc., you put those into the tech group, you're roughly 50% of the S&P 500 that's in technology. So you don't need to take all this risk. The earnings growth is starting to reaccelerate in these 11 sectors of the stock market. So 10 of the 11 sectors are starting to improve, and the technology sector is still going to grow strong, but it's going to grow at a slower pace. So we see a rotation occurring. If it doesn't rotate, we're looking at a fairly good-sized correction, if not bear market. And if the 10-year Treasury goes above 5%, we think we might have a nasty bear market. So it's gonna take something to get the market to move, to rotate. Probably won't be the easiest thing in the world to do, but we think there's something's got to be the catalyst. And usually it's a bear market that's the catalyst to get people to sell those growth stocks that have done so well into other things that have been lagging behind. But the growth rate of the other sectors of the market are really starting to pick up. And so the lower you go in market cap, the more attractive it is. Now I want to show you this chart here. This is the Purchasing Managers Index. So the U.S. ISM Manufacturing Purchasing Managers Index, the PMI. So when it's above 50, means the manufacturing sector of the economy. This is the engine, right? This is what makes everything go. So when the PMI is above 50, it's expanding. And when it's below 50, it's contracting. So we've been below 50 for over 2 years, except for 1 month. Except for 1 month below 50. So the Trump policies are designed to make this go. So bringing back manufacturing to the U.S., giving people lower taxes, they manufacture here, creating jobs. So this is the Trump policies that we think will start to reaccelerate. They already are a little bit. They're going down less and less. So you can see that the trend here is that it's still contracting, but it's contracting at a slower pace. It's been 2 years, right? So it's kind of running out of steam on the downside. And any little improvement, it's going to look like it's really picking up in a big way. This will get those beat up sectors of the market to start to grow again. Those small cap, mid caps, and industrial stocks, energy stocks, basic industry stocks. It'll get those stocks to start to move again. So, plan of action. Foremost, we hate to lose money. That's the most important thing. You can compound your money at such a nice rate if you just avoid the downdrafts. So you don't have to take a 40% cut to your money if that's what would happen. You don't have to do that. So the thing to do is put stop losses on positions that you feel uncomfortable with, that you're not willing to hold in a down 40% market. We probably won't get a down 40% market. If we get a bear market, it's probably going to be down 20 or 30. But if we do have a down 40, you don't have to ride that out. So put stop losses in place. This is what I do as a money manager. And the other thing that we do is, for the core of the portfolio we want to hold through this cycle, is we can hedge it. We can use inverse ETFs on the, say, the S&P 500 or NASDAQ or one of the different broad indexes where you don't have the big volatility, the volatility decay. We can put hedges in the portfolios to protect the downside, to really temper any sort of decline. If you don't do that, then you need to build a durable portfolio. A durable portfolio is not one that has 50% in the technology sector. So there should be a warning label on the S&P 500 at this point. So if you're going to use the S&P 500, use the equal weight, in our opinion, or use the S&P 500 ETF that writes calls, that writes options, calls and puts. So this is the SPYI. So this is the S&P 500. It mimics the S&P 500 pretty closely on the up and the down, but it kicks off 11.7% dividend yield. So if you're down, if the S&P 500 is down 20% in a year, this has a 12% yield. So over a 12-month period, you might be down only 8% with that nice yield. That creates a durable portfolio, plus some baby bonds along with it. That's a nice, attractive portfolio. So yield in a down market is another way of protecting your downside. Too much money is in tech. So just in general, we want to look outside the technology group. There's some really good technology companies that have pulled back nicely during the decline in December. So there's some stocks there that we're interested in. But the energy group, materials, healthcare, they've been really beat up. Materials in the worst way. They've really been clobbered. So we see some opportunities as the economy begins to improve in the next couple of years. Dow Chemical could potentially double in price. Already has about a 7% dividend yield. So that's our deep value play is Dow Chemical. High quality company. Apache in the energy space. J&J, Baxter, you could go on and on. Merck, Pfizer, there's a whole bunch of high quality healthcare companies. They're going to make a lot of acquisitions this year. We think that's baked in, and there's a lot of good companies to acquire. M&A is coming back. So M&A's been on ice for 4 years. There's a lot of really good targets. Hershey, so Mandalay's been after them. The other candy company. They want to buy Hershey. Hershey recently turned them down. We think the trust is going to have to do the right thing and do the right thing for their their trustees, for the beneficiaries of the trust rather, and they're probably going to sell. They're going to sell at a nice premium. Walgreens has been in play, so we think they're going to go out. That's a really cheap stock. Kohl's, they had an offer at $24 a share. They turned them down. The stock's $14. Someone's coming back for sure. Macy's got great real estate. That's always in a rumor mill as well. Capri, this is the luxury good company. We think they're going to sell pieces off of that. Jack in the Box, really interesting. Jack in the Box is the cheapest by far of the restaurant companies. We think that has a potential of being taken private. Viking, Avondale, Grill. Grill has so much potential over the next, say, 5 years. They've or more. They have a product that's probably can generate $100 billion in revenues. It could be one of the largest companies, that cancer tests that they have. And Avanex is our play on Alzheimer's, which we think gets approved sometime maybe July of this year in Europe. So there's four really good healthcare stocks that could add significantly to the growth rate of any of the larger companies in time. The Russell 2000 is a great way to play the Trump policies. So that's America, the Russell 2000, and it trades at a discount to Apple in terms of market cap. So if a little bit of money moves out of Apple, a lot of money could be rolling into the Russell 2000. It's tricky though, okay? So I own the Russell 2000 with sweaty palms at times. So this is a thing that for now you trade, and as the market, if it does correct, you take a nice position in it. And if it doesn't correct and Trump's policies really get going, you want to own this in a big way. It should return really nice returns. In a big way, we mean maybe a 20% exposure to the overall portfolio. Emerging healthcare, we did really well versus the XBI last year, and most years we beat it. But the XBI, we did a really good job beating it last year. We had Viking that was a big winner for us. Veryu will probably announce their clinical data during JP Morgan week. We think it's going to look really, really attractive, knock on wood, right? We think that data looks good. It's a high risk investment, just keep that in mind. But that keeps the lean muscle mass when you're on these GLP-1 drugs, weight loss drugs. So that's a really interesting company that I was talking to a really smart biotechnology executive today, and I was talking to him about this company. He wasn't aware of it, and it's like, yeah, you got a 5 or 10xer on your hands if that data looks good. The technicals of the markets, we're a little concerned about the technicals. The technicals are rolling over a little bit. So December was not good. So you can see where we were in December. We took a couple percent out of the S&P. It kind of put us into this rollover pattern. Here's the upper end of the band, right? So we're below the upper end of the band. That's good. We need to build somewhat of a base here. We broke the 50-day during December, and again, as we started the new year, and at the end of December, we broke the 50-day, and we kind of bottomed out at a support level, a short-term support level. And it's gone back above the 50-day and then a little bit above the 20-day, but it hasn't broken above that rollover. So we're a little concerned about the trend of the overall market, the technicals. We'd like to see another movement higher. We think a lot of the performance of the market could come in a very short period of time this year. Maybe it's the first part of the year. We have a lot of performance, and then we have to grind it out or go lower the rest of the year. But as the technicals go here, we need to watch this very closely because really good support is quite a ways lower at this point in time. So remember, you got to have some risk management in your portfolio. My firm, that's what we do. We do a lot of risk management. We try to pick really good stocks as well. We love the smaller companies in the S&P 500 and lower. Love the small caps. Got to be careful with those. And then there's a lot of really good biotechnology companies, small cap biotechnology companies we like a lot. But just remember, this is a year of change. There's going to be a lot of change in the markets because Trump's policies are just completely different, and you have to protect yourself. Thank you very much. And if you have any questions, just ping me or come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. If you have any questions, you could just email that site, or if you want us to help you with your investments, we're happy to do that as well.